Okay, what's up everyone? This is Training Grounds episode 7. Today we will be talking about liquidity and liquidity sweeps. I've already mentioned it in the previous strategy video, but I thought we should get into more details on this whole thing. So just excuse that trade I took. So let's kind of explain liquidity. So essentially liquidity represents the number of orders available at a certain price. So for example, you see a market going like this, it's consolidating, and you see a big push down below, and then there are orders at that level where people want to fill their orders. Retail traders and institutional traders usually have a stop order somewhere down here, if market is moving here. So institutions just push price down so they can fill this order in, so they can get more liquidity in the market, and then price will just reverse off of that usually. That's basically liquidity sweep as well. If a market has high liquidity, there are large volume of trades, so money is flowing into the markets. For example, like the Nasdaq has trillions of dollars flowing into it every single week. There are tight spreads, so if you check your screen, you can see a spread here. So if there's a really liquid market, the spread will be small between orders. So that means if you place an order, your order will get filled really quickly at the price you actually want to enter at. Then it's also easy to enter and exit trades if there is a lot of liquidity in the markets. So kind of to sum up, liquidity resembles the number of orders available in the markets at a certain level and the amount of money that's flowing into markets. Okay, so let's look at it here. So first off, we see that we have a CME gap here. A CME gap stands for Chicago Mercantile Exchange Gap, which is just institutions communicating with each other, and then they are filling their orders in with each other. So there will usually be a gap right here, as you can see, where there were no orders filled, because this is the 11th of April. So this is market close, and then the next candle here up here is the 14th of April, which is Monday's open. So there's a big gap right here, which there were no orders to be filled, and the next order here was filled. Boom. And then this just drove price up. It doesn't necessarily mean a CME gap will drive markets up. A CME gap can also be bearish. It doesn't really matter. There is just zero orders getting filled right here because it was during the weekend, and markets are not open on the weekends. They're open from Monday to Friday. Okay, so we see that there is this gap right here. So we can mark out this gap right here, and there will be orders in here which institutional traders place their orders at. So they want price to go up, so they want to drive price upwards. So they put their orders in here, somewhere here, a pending order. You can do a pending order yourself. Go to, on Trade Locker, you can go to this little plus icon and then click pending, and that will give you a pending order. So if market pushes in here, you know, you see the open, boom, you're like, okay, I want to get in this long. And then price just pushed back down. They filled the orders in for pending orders. So that means a lot of money was in there. There were lots and lots of orders in there, which means money will flow into the markets if their orders get filled right there, which is what people want. And then you can actually see that market pushed down to fill these orders in, and then they pushed it back up. So they would probably get stopped out if they were in for a short. So this is basically what liquidity is: getting orders into the market. So pushing price down or pushing price up to get money, liquidity in the markets. Let's look at another example of this. There is also a gap here, but this is not a CME gap because this was during this is the 15th of April, this is the 16th of April, so this is just an overnight gap. But there were again no orders filled in here because the last candle close is 22.55. Market closed for an hour there, so institutions can communicate with each other, and then the next candle opens at midnight for me. So we can see this gap as well. Boom. People put their orders right here, their pending orders. We can see the market pushing up above the CME gap, their orders got filled in, liquidity is in the market, so now they can just dump the price. As you can see, boom, look at this. This is crazy. Bomb, just straight down moves. That's actually wild. I wish I would have caught this trade on. I may actually have caught this trade on NQ. I'll check back later. So we actually filled in this CME gap as well with this short. So usually CME gaps or overnight gaps get filled in during the week. Sometimes it doesn't happen because we're pushing for all-time highs, or we're just pushing down, pushing the price below like a certain level. It depends, but there are lots of times when we actually fill in the CME gaps. So for example, we have a CME gap here. Boom. Your eyes will kind of just start focusing on things like this. And then there were no orders getting filled up here, probably because there were none. And the market just dumped. And this happened on the 21st of April. And then we go on to the 22nd of April. Boom, right here. And then it actually happened. So the fill happened that same week. If you like to take swings, CME gaps are a pretty good opportunity to take trades. Let's look at an example here. This is another gap right here. This gap got filled in until like 50% mark, basically. And then it probably will fill in sometime during the next few weeks if we are not just pushing for all-time highs right here. We can see all-time highs up here, by the way. Boom. Looks like we are pushing because this weekly candle is just crazy. There was even a slight gap right here, but more on that probably later. So this is liquidity. Liquidity means getting money into the markets, filling as much orders in as possible. I'll look for another example for you guys, which is kind of like a bullish reversal. So liquidity sweep, then we reverse off of that in bullish direction. Let's look at it right here. We have liquidity under here. You can see the gaps right here. So if there's like a low with wicks, that usually means it's liquidity right there, because market just push down, fill their orders, and then move back up and then closed above that line or at that level, whatever. So you can see, you can mark out the liquidity right here. We go down, sharp dump, sweep it. We go back up a little. We react off of this gap, but that's whatever, next episodes probably. And then we push back down, sweep liquidity right here again, and then we push our orders back up. Another example, let's see. I just want to show you guys some clean sweeps. Okay, again, you see this high right here. There are big wicks, so orders got filled in right here. You can mark the wicks out as well. And then you see price just start consolidating. We pushed our orders back in, up high, and then boom, we came back down. This is a 15-minute time frame, but it works on every single time frame. You can go on the 1 minute, 5, 15, 30, hourly, 4 hour, whatever. Let's see another example. Boom, we have a high here, really big wick, orders got filled in, market dumped, and then boom, we push back up, and then market dumped again. This is liquidity, and liquidity sweeps as well. I'll show you guys another example, something clean. I want to look at something clean. Okay. Well, what is this candle? Yeah, CME. Okay, just give me a good example for the learning traders, please. Okay, here, big wick right here, push back up a little, go back down again, back up, back down, sweep liquidity, and then we just drive price up. Boom, continues. And then this is probably some news candles, and then we have a gap right here. You can see this is a bearish CME gap, but then again it got filled. Boom, up to the top of it. They got their orders filled in, and the market just dumped back down. Continue upwards. News. I'm trying to find another example. I think I showed this one, maybe I didn't, but again, low, push up, push down, boom, 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 push the markets back up. So, Training Grounds episode 7, liquidity plus liquidity sweeps explained. The homework for today is for you guys to spot 5 liquidity sweeps today. It will take 5 minutes. Jot down some keywords, key sentences, phrases, whatever. Tomorrow I'm coming with another psychology video. Peace out.